Stop the insanity. Get your focus back onto what really matters in life. Your faith, your family, your finances, and your future. Sit back, listen, and change the trajectory of your life. You are listening to the Money for Life podcast. Let's welcome your hosts, Teresa Kuhn and Rick Sapio.
Welcome, everybody. This is Rick Sapio, and I love the title of this podcast because somebody said, nobody knows what the hell they're doing. I was about 16. And I'm like, well, somebody has to know what they're doing. But when it comes to the topic of risk, do you know how much risk you are taking? So I am with my partner, Teresa Kuhn. Teresa's got an interesting background, married for over 30 years, if I can say that. She went to law school. She got a law degree. In the middle of being a lawyer, which was her career, she decided to get into finances. And then she decided to find the very best product on the market to sell, which she does over and over and over. And she's become one of the top in the nation at this particular product. But that's not what this is about. This is about risk. So Teresa, I've learned a lot from you about risk taking, and you've completely changed my point of view on risk, because I didn't realize that if I made 20% a year twice, that means the first year was up 20, the second year was up 20, but then I lost 50 the third year. I'm kind of back where I started, if you think about it, but people don't look at that way because they go by averages. And so the numbers are all skewed, and we can talk about Dalbar later. So take it away. Why do you think people don't know how much risk they're taking?
This is one of my favorite conversations, when it comes to money. And just to give you a little bit more idea of my background with money, I have a finance degree and I worked at a Wall Street firm before I went to law school, during college, before law school, then went back to working with money. I love observing people and culture and humanity. What I've noticed in my almost 30 years of working with money is that most people take so much risk unnecessarily. And I think there's so many reasons for it. And we can talk about that. And I know you see this also. We work with a lot of business owners, and they take risk in their business, and then they take risk in their portfolios, and they take risk with real estate, and they take risk in private equity deals. And when the day comes and they're looking at all their finances and there is an economic downturn, everything is at risk. And they're like, holy crap, what did I do? Right? So we're either programmed to think we have to take risk in order to grow wealth. It didn't used to be that way. I think Americans used to save money and appreciated having reserves and savings, a nice percentage of their dollars and their assets and savings without risk. But today it certainly is not the case.
You know what I think changed it? Prior to, I don't know, it was the 70s or 80s, when you used to have pension plans, and the majority of workers had a pension plan. So they went to work, the money went into the pension plan. They didn't see it. They weren't allowed to touch it. Even though people know you're supposed to buy low and sell high, human nature has us buy high. We got to buy that stock because it's up. So human nature has us buy high and sell low. So in the 80s, when it shifted from your company providing you a pension, and it shifted to no, you could do it yourself, IRA, 401k, you could do it yourself, people began taking risk. There was a massive shift in mindset, because now they're managing their own money. And guess what? They're not equipped to manage their own money. It's insane. Whoever came up with this idea for a human being to manage their own money has led to this explosion of risk. So let me ask you, in preparation for this podcast, we talked about a quote. And I'm going to read a couple that you came up with. Risk comes from not knowing what you are doing. And that's by someone who's done a pretty good job managing money, who currently has $100 billion in cash. That's Warren Buffett. He also says wide diversification is only required when investors do not understand what they are doing. So you just hit the nail on the head. People have money all over the place. So why do you think people do that?
Oh, lots of reasons. You're right about the history of money and when people started chasing risk. I think there was a concerted effort from Wall Street, from corporate America, right, to misinform people to take risks, because it shifted the corporations taking care of their employees in terms of their future income and retirement, shifted that risk to the individual. And that opened up so much more money to Wall Street. So I think it's the programming. I think it's the financial information that's out there. If it was for lack of information, right, you could say, well, people don't know any better. But Rick, there's not a lack of financial information or education. There's tons of financial information and education. But I think it's misinformation. I think it's bad information. I think it's information that's designed to benefit the retailers of financial products, right? If people were to invest in their business, and this is for business owners, or if people who are employees would take their money and save it in conservative investments and follow Warren Buffett's first rule of money, which is don't lose money, right? And the second rule is to follow the first rule, don't lose money. They would have so much more money and so much more peace around their money instead of chasing risk.
I love it. I have a quote on my wall. I can't see it from here, but I know where it is. Warren Buffett. First rule, don't lose money. Second rule, always remember the first rule. And people lose money all the time. It's insane. So you shed light on something that I had not looked at in a long time, which is the Dalbar study. And the Dalbar study, they look at 80,000 accounts a year where people invest in stocks and bonds and at different discount brokerage firms and whatever. And what the study found is, this has been going on for more than 50 years, that the average person doesn't even beat the return of T-bills, like 2% a year. But they're trading and trading and trading. Now, if you think about it, this is something I told you about. If you take the most successful people, the people that actually know what they're doing, that study it, they have 10,000 hours of practice, and you lop them off the top, that means the average investor is getting hammered trading stocks. And yet, what happens when you turn on the TV? You can do it yourself. Open an account at our firm and you could do it yourself. And all they're doing is preying on human nature.
They are. And the Dalbar study is one of my favorite studies because it is objective. It studies from an objective perspective, actual investor performance. It does not have the influence of Wall Street's research to give the numbers. And so it's a very, very important study. And if you're not familiar with it, you should go check it out. It's called Dalbar. It's spelled Dalbar. And it's a research firm that studies objectively actual investor returns. So does this mean that people shouldn't invest in the market? I'm not saying that at all. What I'm saying, and I think what we're saying, is that people take way too much risk with their money. If they were to look at their balance sheet, look at their assets and see what assets, right, have risk exposure, they'll be very surprised and realize they really are taking a lot of risk. And Rick, you and I have talked about CPAs, and I query CPAs all the time whenever I run into them. And I always ask them, hey, tell the truth. What percentage of your clients actually make money in the markets and in their investments? And what do you think the answer is, Rick?
I've queried a lot, and it's shocking because they always say it's horrible how they perform. And I always say, if you're watching hundreds and hundreds of clients year after year after year lose money, why aren't you telling them to stop? And the average CPA says, well, it's not my job. Isn't that weird to you?
Well, it's very weird, although some CPAs actually are now investing their clients' money, and that's been going on for a long time.
Yeah, I don't know if that's good or bad. I haven't analyzed that, but the reality is, where are we landing on all this? I think, and we think, and we've written a book about this, people should take 50% of their net worth, their liquid net worth, and have it in the absolute safest products available, tax efficient products. And I know we're going to do a podcast on the 100-year savings solution, which talk a lot of this. People always question, why would I put half my money in something really safe? And the answer is 2008, 2001, 2020 coronavirus. Events happen. Divorce, a medical issue, tornado, your business has a really bad year and you need money. It's incredibly important from a perspective of the four things related to money for life, which is faith, family, finances, and future, that you have safety built into all four of those categories. And that's why I started with you being married 30 years. There's a certain quality of individual that you are and that the people that we attract, they want safety in those four areas of their life. They want to know they're not bouncing around from church to church to church. They're not bouncing around from spouse to spouse, not bouncing around from financial product to financial products. I'm covering the 4 categories. And they're not bouncing around with their legacy. They are solid, they're secure, or they aspire to be that way. And, we propose in these podcasts to teach you how to be better in those 4 areas and how to be more secure in those 4 areas. But we try to use the values that we talk about often: simplicity, probability, and leverage. And Teresa, tell me more about what types of products, when you say to take no risk, what types of products are you suggesting that people should look at?
Very specific types of life insurance products, very specially designed whole life products, very specific annuities that guarantee income for life. So the 2 strategies that we work with, I know it sounds self-serving, but I went out to the marketplace in search of the products and the solutions that I knew would serve my clients with the real needs that they had. And you said, Rick, people should have 50% of their money in guaranteed type of products. And I know people are thinking, they're crazy. I would pose this question to you and be honest, be completely honest about it. If you can, add up all of the dollars that you've lost in different investing schemes and in different real estate investments or stock investments or crypto investments. Just add all that up and ask yourself, if you had every dollar back without a return, would you be better off than where you are today? Rick, what do you think that answer would be for most people? If they were really honest.
Yeah, I think when it comes to money, they just can't be honest. They cannot do it. It's impossible for people to be honest. I don't know why. When we had our mutual fund superstore years and years ago, which we closed because we couldn't get over this, what I'm about to tell you, we had thousands of clients and they would open an account and they would say, I'll just make up a number. They would put 25,000 in the account and they would trade mutual funds up and down. They would buy the fund that was hot. And then when it went down, they'd buy the next fund that was hot. And then when it went down, they bought the next fund that was hot. And we would say, that's great. Here's your account. You started with 25,000 4 years ago, and now you have 21,000. If you put your money in this managed account that's managed very conservatively, you'd have 50,000. Even showing human beings the numbers, black and white numbers, showing them, they could see it with their own eyes, they couldn't believe it. Like, that's not true. I bought a mutual fund that was up 10%, even looking at the numbers. I think when it comes to money, people have to realize that they don't know what they're doing and they cannot do the math. And I've seen this with the smartest engineers. I've seen it with the smartest human beings. They just can't do it. They cannot look at numbers when it comes to financial returns year after year and get that they are underperforming. I don't know why it happens, but it happens to the best and the brightest. So that's why when I look at you, who I've invested with over the years many, many times, I look at you and I say, if I'm going to get a guaranteed tax efficient return of 3.5% or 4% a year, every single year, like clockwork, like boom, 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 that gives me safety and security. It lets me sleep at night. But people go, wait, you could buy an apartment building. I go, yeah, but what happens if 2008 happens? Or what happens if there's a coronavirus? And what happens, like my friend bought 7 apartment buildings and went bankrupt? Yeah, you can't. I'd rather have my money safe. Now, the other half, and that's for another podcast, you can take more risk with. But you're absolutely right, Teresa. And I completely respect and trust your background and all the diligence you do. People don't know this about you, but if Teresa tells you something, that means she's probably researched it for 100+ hours.
Yeah, I am definitely one of those. And some people are rolling their eyes going, yeah, right. I will say one thing. Okay, let's say you want to buy the apartment buildings. There's a better way of buying the apartment buildings using these policies and then enjoying the double dipping that you get with the uninterrupted compounding in the policies and buying the real estate. That's for another podcast. But, Rick, I'm guilty of this. I work with the products that I work with because I'm wired not to take risk with my clients' money. I've taken lots of risk. And I'm one of those people that say, if I had every single dollar back that I've lost, I'd be in a better place. And I'm trying to teach that to my nephew. I'm trying to teach that to my son. My clients, it's an age thing too. When they get to their late 40s and 50s and 60s, they totally get it. Like if they're honest with themselves, they totally get it. Now, if we can teach the younger generations to learn from the mistakes of their elders, wow. They could accumulate so much wealth without taking unnecessary risk.
Before you wrap up, I just want to share a story that a friend of mine told me, which I just think plays into this, because risk is also people buying stupid things that they shouldn't be buying, like many of us do. A friend of mine told me about his buddy was at the birthday party of a 16-year-old nephew, and the 16-year-old nephew had a landscaping business, and he had saved up $6,000. So on his 16th birthday, the family was celebrating the fact that they were going to go take the $6,000 that he saved and buy a nice car. And the $6,000 was going to be put as a down payment on a nice car. And the uncle said, wait a minute, at the party, I'm about to buy a condominium. It's a $12,000 down payment. Why don't we go to 50-50 on the condominium? The family was like, no. He wants this car. He saved up for this car. And as the story goes, this kid, instead of buying the car, went 50-50 on the condominium. This was about 15 years ago. 10 years later, at the age of 26, this kid owned 15 properties and was already a millionaire. Still didn't buy the new car yet. Years after that, maybe it was about 17 years ago. So now he would be, about 33, 34. I'm told he has 40 properties now. Now, what would have happened if that 6,000 went to the car? Risk is also doing dumb things with your money. And unfortunately, in our culture, we do it all the time. You got to upgrade the house. You got to upgrade the furniture. You got to upgrade your wardrobe. You've got to upgrade your friends. And we have this upgrade mentality. If you run out of space in your house, you got to get public storage to put your crap in. We build more square footage of public storage than other nations build for human beings. And we do it to put crap in. So there's other forms of risk that make money vanish, and is buying a new car as an example. So I'll let you take it away. This is a fascinating topic. I hope it made you think. It made me think. So thank you for your time and attention.
So if you're wondering, okay, I get this. What can I do different? What we would have you consider, take inventory of your assets and take inventory. You can do 1 to 10. How risky are these assets for each one, right? And if you have over 50% of your assets where it's above 5 or above 3 in terms of risk, it's time to give somebody a call and make some real changes. Remember 2020 and the pandemic. It was a gift in terms of allowing us to see our vulnerabilities from a financial perspective. That's something that happened with everybody, Rick. Just remember, because we are the United States of amnesia, right? 2008 to 2010 happened. People were really hurt. And then what happened? A decade of amnesia. And 2020 slapped us in the face. There's going to be another 2020. There always is. It's just life. So I challenge you to do that inventory and rate each asset. And for next time, be well, be safe.
You have just experienced Money for Life. Implement these strategies today and create a life by design. Have a blessed day.